that, let's also find out what the outlook is then when it comes to Indian banks. What exactly is the way forward? And Deepali Seth Chhabria is joining in from S&P Global Ratings Associate. She's Director for Financial Institution Ratings. Thanks so much, Deepali, for taking time out. Just wanted to get in then, first up, an outlook on the overall banking sector as a whole. When it comes to deposit growth and asset quality, particularly these two metrics, how do you see them shaping up?
Sure, thank you. Good morning, and thanks for having me here. So, in terms of the outlook, in terms of asset quality, Indian banks are actually in a sweet spot at this point of time. Asset quality is a lower risk at this point of time than it used to be a few years back. In fact, we expect that the asset quality will continue to improve. We are expecting the NPA, the big loans, to actually decline to 3.5% by next fiscal year. And this is because of confluence of structural and cyclical factors that are happening. Though, of course, there are always pockets of stress. For example, the unsecured personal loans have grown rapidly, and that would contribute to incremental NPLs. In terms of the deposit growth, yes, the liquidity tightness is one thing that we are currently seeing in the system. While the loan growth has remained good, the deposit growth has not been able to keep in pace. We believe that the funding conditions would play a crucial role in constraining the loan growth for many banks in the country. Because the deposit growth have not been able to keep in pace with the credit acceleration, the loan to deposit ratios have been kind of deteriorating sharply. And we think that this problem is more pronounced in the private sector banks because they have been growing faster than the industry. So the loan to deposit ratios for them have touched 93% vis-a-vis 80% for the banking industry.
Right. Deepali, also wanted to get your sense in on what you're making of the liquidity conditions right now, because that really seems to be the core and the bone of contention for the banking pack right now.
Sure. So we think this is not sustainable. In our base case, we believe that the credit growth will have to kind of decline. We are projecting that the system level credit growth would moderate to about 14 odd percent from 16%. In that situation, also, we think that the deposit growth will continue to lag credit growth, but the gap would have reduced, and the competition for deposits will be manageable in that kind of situation.
Okay, fair enough. Take us through down the line what the outlook is when it comes to, growth when it comes to the PSBs versus some of the private sector banks. Are there any, glaring differences? Are you now seeing some sort of a catch up as well when it comes to some of the PSBs?
Private sector banks have historically been growing at a faster pace than the public sector banks, and we think that this kind of trend would continue. Though we think that the private sector banks that are currently growing at 18% will have to kind of slow down. Probably they would slow down to 15 odd percent in our base case. And the public sector banks would also slow down somewhat from 13 to 11. For public sector banks, while the deposits is not an issue, for them the vulnerability is capital. They have been their capital levels have been lower than the private sector peers, and that is what has been constraining their growth. And at the same time, the risk management practices, especially for the small, medium-sized public sector banks, have been kind of evolving as compared to the top four private sector banks.
All right. And what's the outlook then, Deepali, when it comes to falling interest rates, and how do you expect the sector to be impacted on the back of this? Are you worried as well that down the line, just a two-part question, whether or not we could see the rising competition for deposits hitting the margins of some of the banks?
So yes, we do expect that the margins will actually go down. In the base case of a slower loan growth, also we are expecting the margins to decline by about 10 basis points in the next fiscal year. And that is also on the back of policy rate cuts. We're expecting a 100 basis point policy rate cut in the next fiscal year. So all of that will culminate into a decline in the margins. But if the loan growth does not slow down and there is, say, a deposit pause, and we could see more sharper impact on the margin. We've done some study, and based on that, we believe that the margin impact could actually double. So instead of a 10 basis point, we might actually stability the ROAs to decline about a 10 basis point.
Right. The other thing, Deepali, that I wanted to talk about, and I'm just quoting very individual specific examples here. You can choose not to address that if you wish. But I wanted to pick up on two of the largest private sector banks, that HDFC Bank and ICICI Bank. And, just wanted to understand what your view is on both, given the entire macro environment right now. I know it's not an apple-to-apple comparison that I'm making here, and what your ratings rationale is on both.
So we have both of them at the sovereign level, which is between minus stable. And we believe that both of them have buffers against the downside risk, and they should be able to withstand moderate weakening in their funding profile and as well as pressure on margin. In fact, for HDFC Bank, post-merger, their loan-to-deposit ratio is kind of decline or deteriorated to 110%. We believe that they will have to improve on that. They are working towards that, and we think that it will take at least about 3 years for them to reach to pre-merger levels of 90% LDRs.
The outlook when it comes to Axis Bank and Kotak Mahindra Bank in particular, do you think that the moderate weakening in the funding profile is unlikely to really affect ratings for both of these banks?
So for them as well, we do think that we've already actually factored in some amount of weakness in their funding profile. We do factor in the fact that they have slightly higher deposit concentration and higher dependence on wholesale borrowings. So because of that, we think that this moderate deterioration, they should also be able to withstand that without any major deterioration in their credit profiles.
Okay. And finally, do you think that there is a high likelihood that in the case of some of the PSBs requiring support from the government that they will come through?
Yes, we do believe that. We have always seen that in the past as well. In the last few years, when the PSBs were cleaning up their balance sheet, we did see government pumping in a lot of capital into the PSBs. So, while our base case is that the PSBs should be able to grow without any major need for capital for the next couple of years, but if they need support, the government will provide them support that service.
All right. Thanks so much for taking time out and joining in. Time for a